Cost classification extends beyond identifying production and non-production costs to encompass systems that facilitate managerial control, responsibility accounting, and performance evaluation. Modern organizations process thousands of transactions daily, requiring systematic methods to classify costs, assign responsibility, and analyze operational performance. Cost codes, cost behavior analysis, cost objects, and responsibility centers therefore form the foundation of an effective management accounting information system, enabling managers to allocate resources efficiently and monitor organizational performance. A fundamental feature of management accounting systems is the use of coding systems to categorize transactions. A code is a sequence of numbers, letters, or symbols assigned to a transaction, account, department, product, or activity to facilitate recording, classification, retrieval, and analysis of financial information. Coding enables large volumes of accounting data to be processed quickly and accurately while reducing duplication and clerical errors. Common coding structures include numerical codes, alphabetical codes, hierarchical codes, and faceted codes, each designed to classify transactions according to organizational requirements. Cost codes may identify departments, cost centers, products, projects, or expenditure categories, allowing management accountants to generate reports for budgeting, variance analysis, and cost control. Effective coding systems, therefore, improve the efficiency and reliability of management information systems while supporting managerial decision-making. Management accountants frequently use graphical representations of cost behavior to understand how costs respond to changes in activity levels. Graphical analysis provides visual interpretation of cost patterns and supports forecasting, budgeting, and decision-making. A fixed cost graph is represented by a horizontal line, illustrating that total fixed costs remain constant regardless of production volume within the relevant range. Examples include factory rent and insurance premiums. A variable cost graph begins at the origin and rises proportionally with activity, reflecting costs such as direct materials and piece rate labor that vary directly with output. Semi-variable mixed costs contain both fixed and variable components, and therefore begin above the origin before increasing with activity, as illustrated by utility bills comprising standing charges plus usage costs. Stepped fixed costs remain constant over a range of activity, but increase sharply when production exceeds capacity thresholds, producing a staircase pattern. Interpretation of these graphs assists managers in estimating costs, evaluating capacity utilization, and conducting cost-volume profit analysis for planning purposes. Another fundamental concept in cost accounting is the distinction between cost objects, cost units, and cost centers. A cost object is any item for which cost information is required, including products, services, projects, customers, departments, or activities. Management accounting systems exist primarily to measure the costs associated with these objects to support pricing and profitability analysis. A cost unit is a quantitative unit of product or service to which costs are assigned, such as 1 ton of cement, 1 hotel room occupied, 1 passenger kilometer, or 1 legal consultation. Cost units provide the basis for calculating unit costs and comparing operational efficiency. A cost center, by contrast, is a location, department, machine, or person for which costs are accumulated and controlled before allocation to cost units. Examples include machining departments, maintenance workshops, warehouses, or customer service departments. Cost centers facilitate responsibility accounting by assigning cost control to specific organizational units. Responsibility accounting further classifies organizational units into cost centers, revenue centers, profit centers, and investment centers, each reflecting different managerial responsibilities and performance measures. A cost center is responsible only for controlling costs and does not directly generate revenue. Examples include maintenance departments or human resource functions. A revenue center focuses exclusively on generating sales revenue without direct responsibility for production costs or capital investment, such as regional sales offices. A profit center is accountable for both revenues and costs and therefore measures performance through profitability. Divisional operations or retail branches commonly operate as profit centers. An investment center has responsibility for revenues, costs, and the efficient utilization of assets employed, with performance evaluated using measures such as return on investment, ROI, or residual income. Investment centers provide managers with greater autonomy while encouraging efficient capital allocation and long-term value creation. The information requirements of managers differ according to their responsibility center. Cost center managers require detailed information on actual costs, budgeted costs, labor efficiency, material usage, and overhead expenditure to maintain operational control and improve efficiency. Revenue center managers focus on sales volumes, selling prices, customer demand, market share, and revenue growth while requiring limited cost information. Profit center managers need integrated reports containing both revenue and cost data to evaluate divisional profitability, pricing policies, and product performance. Investment center managers require comprehensive financial and non-financial information, including profitability, asset utilization, cash flows, capital expenditure, return on investment, residual income, and strategic performance indicators to optimize long-term organizational value. Consequently, management accounting systems must provide customized information appropriate to each managerial responsibility level, ensuring effective planning, control, performance evaluation, and strategic decision-making across the organization.